All right, let's talk Microchip. On the surface, their latest earnings report looked pretty okay. But the market? Yeah, the market saw something different. And today on Talk Tickers, we're going to dig in and find out exactly what spooked investors during that Q2 earnings call. And that right there, that's the story the market told. A 3.1% drop in after-hours trading. So what happened? Why the disconnect between the headline numbers and the stock price? Let's get into it. So here's how we're going to break this all down. We'll start with the quarter at a glance, the big numbers. Then we'll really get into the weeds, looking behind those numbers. After that, we'll cover management strategy, the outlook that tanked the stock, and finally, we'll give you our take, what we think happens next. Okay, first up, let's just get the basic facts on the table for the September quarter. Their non-GAAP earnings per share, or EPS, came in at 35 cents. Now, that was a little bit better than expected, beat the consensus by about a penny, so a slight beat. And on the revenue side, they reported $1.14 billion. That was pretty much exactly what Wall Street was looking for, so right in line. So when you just look at the scoreboard, you're probably thinking, hey, a beat on earnings, in line on revenue. What's the big deal? And you're right, on paper, it looks fine. But as we all know, the devil is always in the details, and especially in the forward guidance. And this is where the story gets really interesting, because this quarter was all about a huge tug of war between some genuinely positive signals and a much, much cloudier forecast. The whole quarter was basically a story of these crosscurrents. On the one hand, you have some really good stuff. The book-to-bill is up, bookings are growing, inventory's coming down. But on the other side, pulling against all that, you've got soft guidance, worries about demand, and pressure on their margins. Now this number right here, this is the most important piece of good news. A book-to-bill ratio of 1.06. What that means is, for every dollar of product they shipped out the door, they booked $1.06 in new orders. That's a classic sign that demand is finally starting to pick up, a real green shoot. But, and you knew there was a but coming, here's the catch straight from the CEO. He's saying, yeah, the orders are coming in strong, but customers are telling them, hey, don't ship that to us until the March quarter. They're using Microchip's fast delivery times to keep their own warehouses practically empty through the end of the year. And that timing issue is what really got the market worried. And that same kind of confusing push and pull story is happening with their profitability too. Management kept talking about how healthy their product margins are, so you have to ask, why did the final reported number look so rough? Well, this chart just lays it all bare. The margin on the actual chips they sold was a super strong 67.4%. But then, wham, they got hit with a massive 10.8% charge for things like inventory write-offs and idle factories. That dragged the final reported margin all the way down to 56.7%. So in this tricky environment, what's management's game plan? Well, they're basically running two playbooks at the same time. One is all about playing defense, and the other is about playing some serious offense. So on the defensive side, it is all about being smart with their money. They're keeping a tight lid on spending, aiming for under $100 million for the year. They even found a buyer for an old factory. And crucially, they're protecting that dividend for shareholders and using any leftover cash to pay down their debt. It's smart, conservative management. But while they're playing defense with one hand, they're making a big offensive move with the other. And it's aimed squarely at the hottest market in tech, the AI data center. And the centerpiece of this whole pivot is their brand new PCIe Gen6 switch. Now this thing is a beast. It's built on the latest 3nm tech, it doubles data speeds, it's way more power efficient than the competition, and it's got top-of-the-line security. This is a direct shot at the plumbing of AI factories, making Microchip a key player no matter who's selling the GPUs. Which brings us, finally, to the guidance for next quarter. This is the part of the call that really sent the stock into a nosedive. Yeah, so despite all those positive booking trends, management came out and guided for a slight dip next quarter. Both their revenue and their EPS forecast were below what analysts were expecting. And that right there, that's the number that overshadowed everything else. However, and this is so important, in the very next breath, the CEO expressed a ton of confidence about what comes after this soft quarter. He flat out said they expect 3 strong quarters of growth starting in March. It's a classic wait for it moment for investors. Okay, so let's tie this all together. What does this mean for the stock and for you as an investor? Here's our final take. So how should you be thinking about Microchip after this roller coaster of a report? For the next earnings report, Honestly, we expect them to hit their numbers. They set a pretty low bar. The real catalyst, the thing that will actually move the stock, won't be the numbers themselves. It's going to be what management says about the strength of their order book for that March quarter and whether those nasty margin headwinds are finally starting to go away. And all of that brings us to a market perform rating. The cautious short-term view is a real problem, you can't ignore it, but it's balanced out by those improving order trends and, really importantly, that smart strategic pivot into AI. We think the stock is probably stuck in a range until that March recovery actually starts to show up in the numbers. And before we go, here's a little outrageous but plausible trade idea for you. Think about a pairs trade. You'd go long on Microchip, but at the same time, you'd short one of their competitors that's more of a pure play on the slower auto and industrial markets. The whole idea is to bet that Wall Street will start rewarding Microchip for its AI growth story before its old school business fully recovers, while also protecting yourself in case that broader recovery takes longer than everyone hopes. This is not financial advice.